You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
Welcome, and you are listening and watching the Financial Survival Network. I'm Kerry Lutz, and well, today is 6/19/2021. The markets are down and going lower. Dow at this particular moment down 765 points. Where is the plunge protection team when you need them the most? Well, is this just a blip, or is this the beginning of the end? Markets these days, you just can't tell where they're heading other than up. And that's what they've been doing for years now. And that just can't go on forever. So we need a breather. And maybe this is finally it. What is your opinion? Why don't you send me an email to kl@kerrylutz.com. Let me know what you think. Right now, you're going to hear from somebody who always has an opinion in the markets. And it's not just a casual opinion. It's an opinion built up over decades of firsthand market experience. I'm talking about Gil Baumgarten, and Gil's website is segmentwm.com. I suggest you take a look at it. Gil, it's so great to have you back. So 765 points is a little more than a blip, isn't it?
Well, it's moved many thousands of points since the bottom last March with just a few breathers along the way. So clearly you would expect it to take whatever current negative news has kind of piled up, and then the market just tends to react and overreact sometimes all at once. So the strength and the weakness all come kind of grouped together. So I think it's about time for this.
Yeah. So how much has the market gone up since it's low back in March of 2020, when the reality of COVID, or the reality of our response to COVID, really shook the market to its core?
I think I read that it was the shortest time period on history that the market had doubled in a resurgence of a bull market. So it's quite possible that the 34,000 we're seeing today on the Dow was give or take about 17,000 back then. I think that I don't know for sure that those numbers are correct, but it feels about right.
Yeah, and that's pretty substantial when you think about it, because we've had stock markets going back in this country to the late 1800s. That kind of started emerging after the Civil War in the 1870s and 80s, and then you had Dow, and you had the Dow theory, and markets started becoming more mature. Of course, they're nothing like what they are today. If they traded a few 100,000 shares a day back in the early 1900s, and everybody was like beside themselves. They were wiped out. And now if they don't trade a few 100 million shares a day, we think that something's really wrong here.
Yep. It's gotten much more sophisticated, and technology has really helped accelerate that. Not only the individual investors that have access to technology that helps them trade, but clearly technology has helped the market makers and the like. The market makers have pretty much gotten obliterated by the high-frequency traders, and just technology has brought about a big evolution and has made it a more democratic process. It isn't perfect. It's got some flaws in it still, but it's so much better than it was even just 37 years ago when I got in the business. Spreads between the bid and the ask were 1/8 of a point, and now they're fractions of a penny. So that's liquidity, and that's a good thing. Less friction for the average investor, and so it's all good.
Well, one thing maybe that isn't so good, though, you're probably not familiar out there with the concept of a specialist. And these specialists were granted a franchise on the stock market floor where they would go in and buy and sell as the market needed it. And they brought a certain stability. Those guys now are relics of the past, kind of like runners and all the floor people. I don't even know, does the New York Stock Exchange, did they reopen the floor? And but even still, the New York Stock Exchange is like a backdrop. You hear the bell ring, all that. it's just a screen set.
Yeah.
Kind of
It
like,
was all a manual process up until about 15 or 20 years ago, and now everything has become digitized, and liquidity has become more pedestrianized, more democratized, whatever term you want to use. And on the one hand, I kind of bemoan that high frequency trading firm, and there's bunches of them. Pick your poison. On the one hand, I think it's kind of uncool, and frankly, the SEC's got their crosshairs on it. They don't think that being able to share customer order information for a fractional second advantage is quite kosher, and I wouldn't disagree. However, it manifests a much more liquid market with much narrower spreads. So sharing client information prior to trade execution is what high frequency trading is all about. And it also has a side benefit of making commissions free. The reason why your commissions are free is because they're selling your order information. And before you get all cranked up about that order information, all it does is allow somebody to trade inside of the current bid-ask spread, which is exactly where you would have been in the old day of a specialist, minus 1/8 of a point on top of that. So from a moral position, I'm not real keen on it, but I don't think the SEC should illegalize a process.
yeah, well, so choose your poison, like you said. You could have specialists making 1/8 of a point, or you have these guys making a couple of pennies.
Yeah.
I read somewhere that Citadel considers themselves to be a market maker. That's their official title.
Yeah, that's theoretical. I mean, they've obliterated the old traditional market maker, and Citadel's trades in a much skinnier fractional type environment. So the average investor is way ahead with having Citadel on the other side of their trade, or actually in between their buyer and seller, than the old specialist who had, like you said, had a monopoly as the market maker. And so it's an unsolvable puzzle as far as I'm concerned. As soon as the SEC illegalizes the process, you can just watch a reversal, a widening of spreads, lack of liquidity, and welcome back the old commission environment. So
yeah, well, that's an interesting thing, kind of back to the future, if you will.
Yeah.
That they could, if the flourish of a pen. On the other hand, these high frequency traders are huge campaign contributors, and maybe the SEC will just do hands off, which they've done since the emergence of the high frequency traders. I always call them high frequency fraud. And it is a fraud on the one hand, because like you say, they're taking the information and they're front running all the trades to make them.
Just to make sure that all your listeners are aware of what we're talking about, there's always been a spread between the bid and the ask, and that spread back in the 80s was 1/8 of a dollar, so 12.5 cents. And those spreads, if you look nowadays, Apple Computer trades at a penny spread. So think about, if you're trading millions of shares, how many thousands or tens of thousands of dollars are involved just in that spread. Now contract that spread down to a penny, and maybe you can get a trade done inside of that penny. Now the high frequency trader takes the scrap of the remainder of that penny and executes you at the bid side, providing probably liquidity far in excess of and less friction than the old specialist would have. So on the one hand, I don't really want my order information shared, but on the other hand, I don't want to pay commissions either. And so I think this is the lesser of all the evils, frankly.
Well, on the other hand, you question, so is the ability to get in and out of stocks for nothing, is that really a positive for the market, or is that a negative? Because you think it, in a situation like we have today, it's heightening volatility and causing a whipsaw effect. And this is where the small investors really get slammed. And then go to options X. Every month we have it, but then we have the quadruple witching orders every quarter. And that's where the small investors can really get whipsawed and blown out of the market. One minute you have an in the money option, and the next minute it's out of the money and it expires worthless.
You're talking about the practical side of it all. I agree with you, as that is the manifestation of it. I just don't think it's a good idea to create impediments that have a a positive net outcome by preventing investors or deterring investors from having that type of activity that's normally harmful to them. I just like the more democratized process and let everybody choose for themselves. Now, I would leave you with the warning of choose wisely. That's kind of where I would think things would fall.
That's called like a Hobson's choice.
Yeah.
The best example is when you see this line of cars lining up at the exit, and you know that people are going to go along the other lane and then cut into that lane and tie up traffic further.
Yeah.
But if you don't do it, somebody else is going to.
That's true.
In effect, you're damned if you do, and you're damned if you do.
That is true.
Right?
Yeah, absolutely.
But as always comes opportunity, right?
You got it.
So opportunities in the market, because you're of the opinion today is short-lived. The Fed will come rushing in with trillions of dollars or whatever it takes because the government can't allow the stock market to go down, can they?
Don't just survive, thrive. The Financial Survival Network.
Silver One Resources is an exploration and development company backed by strategic investors Eric Sprott and SSR Mining. At Silver One's Candelaria Mine project in Nevada, there is already a historic resource estimated at 127 million ounces of silver, which Silver One is developing and advancing. The company's Phoenix Silver project, located within the Arizona Silver Belt, is an early-stage exploration project on which native silver vein fragments have been discovered near surface. One grab sample assayed an astounding 14,688 ounces per ton. Yes, that's right, ounces, not grams. Silver One has tremendous exploration potential, is extremely leveraged to the price of silver, and is cashed up and poised to increase shareholder value. Silver One trades in New York under the ticker SLVRF and in Toronto under the ticker SVE. To learn more, go to silverone.com. That's silverone.com.
This is the Financial Survival Network, the information you need to thrive now more than ever.
I don't think so. At some point, they're going to run out of other people's money, but I just don't know when that's going to occur. They have seemed awfully willing, especially since 2008, to really get involved in creating liquidity, and ultimately that liquidity finds its way into the marketplace and tends to boost prices. So we're big believers in buying the dips. I'm not so sure that the minus 700 that we're having today is enough to really get my juices flowing. But being a perpetual owner is a lot better for investments rather than just trying to have a velocity item where you're trading in and out, creating taxes and friction and opportunity for error. We just like blue chip stocks bought relatively inexpensively and held for the long haul, and collect your dividends and call it good. Very efficient tax outcome. So we don't get too caught up in the inertia of upside or downside.
And you're the person that educated me about the benefits of exchange traded funds, and I assume they extend to exchange traded notes vis-a-vis more traditional mutual funds. And that's like one of the best kept secrets on Wall Street. Nobody really knows this or dwells on it, but if you're in the long-term wealth acquisitive mode, this can make all the difference. And if you're doing any kind of estate planning, the stepped-up basis that you mentioned, this is the first time what really impressed me, your knowledge about this, stepped-up basis of stocks that go from, spouses that you don't get with mutual funds. Of course, they're trying to get rid of it, but they're trying to get rid of frequency trading too. They've been trying to get rid of sin since man left the cave.
Yeah,
wasn't too successful with that either.
Yeah. Well, just to clarify for those listeners who might not have listened to that last podcast that we did, or maybe a couple of times ago, mutual funds have a sort of a negative accounting situation built into them. I'm talking about traditional open-ended mutual funds, the ones with 5-digit symbols. You have commingled accounting. And in commingled accounting, whatever happens to the entire fund is what happens to every shareholder. It's not the exact same in an exchange-traded fund, despite the fact that it too is a mutual fund. So the fact that you're sharing accounting with other investors, when you have a big buy and a big sell, you have to, most importantly, a big sell that's bigger than your purchases for the day. That mutual fund has to redeem securities or sell securities in order to meet the redemption of who wants to exit with their large pot of cash. They have to print the gains, and that ends up on a 1099. Normally, what people would see on their statement would be a capital gain distribution or a reinvestment of a distributed capital gain. That really doesn't happen much, if at all, in exchange-traded funds, because shares inside the fund have a creation and redemption unit process where the securities are actually purchased in the open market, and they enter the fund and they exit the fund the same way. So anybody who has a large purchase or redemption is entering or leaving with their representative securities, and therefore you don't have commingled accounting with other investors. The manifestation of that is over a 20-year time period, you may see your, Fidelity Magellan fund, a 5-digit open ended fund, go up by 10x, but it's almost all been realized gain the entire time. You put in 100,000 and it's worth, $10 million, worth $1 million. You have $900,000 worth of so-called realized gain, which has occurred all those years, and you don't carry forward much unrealized gain. Contrast that with an ETF that has almost all unrealized gain. Husband dies along the way, spouse inherits that $900,000 capital gain tax-free, and when she dies and she leaves it to the kids years later, she gets a second step up. And so many people get all cranked up about ETFs and how spectacular they are because of liquidity and the way they're easily tradable, trade intraday, low cost. They're totally unaware of how much better ETFs are from a whole nother reason. And that tax implication of holding an ETF is a great reason to hold them for the long haul and not trade them at all.
So one thing with ETFs, sometimes you don't really know what you're buying, and they're subject to reorgs, and that can dramatically affect unit holder valuations. I guess you kind of had the same thing with mutual funds, but it seems like ETFs are more prone to this. You
mean like a merger between funds?
Well, like USO, the oil ETF. Yeah. A while back, they had all these contracts and they were buying options and selling them and everything else. And all of a sudden, the price of energy went to below zero, and they were caught flat-footed, and they had to reorganize the fund.
Yeah. Well, you're talking about a futures fund, really. And so I'm talking about ETFs in the traditional listed equities sphere, not the ones that are futures backed. And also we would have to throw in the caveat of levered and inverse. So mutual funds, open-ended mutual funds do come in a levered version, but they're much more common in an exchange-traded fund. So I would consider that to be a hybrid security, and I don't think it would be fair to kind of group all ETFs together because once you start to get into futures, leverage, inverse, those are much more eclectic. I'm just talking about long-only, 100% invested, traditional stock investment mutual funds, which is 95% of the ETF marketplace. Those are the ones that I'm talking about with this special tax treatment.
Right. I got you.
Yeah.
Makes complete sense because, you're basically gambling on those leveraged ETFs.
Oh, no doubt. No doubt. You got to know exactly what you're doing. There's all kinds of contango and all kinds of, pricing metrics that get all squirrely. And when we talk about no trading versus trading, those are trading vehicles. You can make an expression of your opinion really quickly and then get out before the degradation process happens to you over a long time period.
Sure. Definitely can happen. Well,
yeah.
Gil, really appreciate you coming on, reassuring us about today's action in the markets. If you needed reassurance,
yep,
to agree with you with what's happening there. And
appreciate it a lot. Your listeners can read my book on Amazon. Foolish is the name of my book, so have everybody go check that out.
All right, and Again, the URL for your website is segment, segmentwm.com. Go
You
there,
got it.
take a look at it. And if you got any questions for Gil, send an email to kl@kerrylutz.com. We'll get it over to him. And while you're at it, sign up for our free newsletter, financialsurvivalnetwork.com. Gil, we will talk to you again probably in several weeks. But if
Thanks,
there's
Kerry.
action, we'll touch base with you sooner, okay?
All right. Thanks a lot. We'll see you.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.